Good morning, traders. It is Friday, July 18th. Taking a look at the charts, yesterday we had that pop and move higher. We talked about this yesterday in pre-market. We had the market dip from an oversold territory. This was about a week and a half ago. And went from a panic selling to a bounce. And then not yesterday, but the day before, we saw this little dip into oversold territory on the S&P 500. We also saw that coupled with some panic selling just before it, which typically means we're going to see a bit of a bounce in the market. And if we look at the SPY, which is pretty much the same as the S&P 500 futures, during regular trading hours, you can see here we had this little green section here. This is where we get into a cycle low. So we had a cycle low pivot in. Is actually the cycle low was actually from the day before, which was right here up this red bar. So we had the cycle low, the market flushed down, which coincided with the panic selling in the futures, and of course the panic selling and oversold. Anyway, we have this market scenario. Each time we get into these kind of green bars, the market puts in these little pivots in the markets where the market starts to find a bottom and start to move higher. And we've just had that little bit of a reset. And so the market is primed and ready to push to new all-time highs yet again. This is going to apply a lot of pain to those who didn't play any of the upside. A lot of people who are short are going to feel a lot more pain. I think today we are actually seeing the Russell 2000 up fairly significantly compared to the others. It's up 0.5%. It's not huge, but we're about to see the Russell push to some new all-time highs. And the reality is most traders are into growth and small cap stocks. And of course, a lot of them will be also on the wrong side, betting on things going down. And so as these markets go higher, it creates more FOMO for those not involved. And of course, it creates a lot more pain for those who are on the wrong side, betting on the markets going down. So probably going to start to feel a lot of stress and emotions when it comes to all this in the market. Is what we tend to see. The VIX and the put call ratio are starting to get to a level here where we're getting close to, I think, a bigger pullback. Now the market has been trading sideways for a couple of weeks, and the VIX is fairly low, and that means people aren't too fearful in general. And so we just have to let this market work itself out and let that happen. The put call ratio is, I like to look at the 5-day moving average, which is this light blue line. It's kind of hard to see. There's a lot in here, but we're back down at these levels where the market tends to have a little bit of a hiccup and increased volatility. And and that's what we've been talking about when we look at our NASDAQ play here. When the NASDAQ has a trigger of a new trend and it moves 15%, we start to get into volatility. And that usually means the market can squeeze a little bit higher, but usually it's going to go into some type of bigger correction. So overall, we're on borrowed time at this point for the stock market. It has made a very significant move. We were able to take advantage of some of that, and now we just need to let it reset, and then it'll give us eventually a new setup. Now, it's interesting. I was looking at, as you guys know, I'm not a news or fundamental guy, but out of curiosity, I wanted to see where we stand in terms of the PE ratios, and I just ChatGPT'd them, and it's pretty amazing. Alphabet or Google has definitely gone to the bottom of the barrel in terms of its PE ratio. It looks like they are kind of getting mowed over by everything else. I think the AI is really going to hurt them. I haven't used Google search and I don't know how long. I use ChatGPT for everything. I just want the answer, although it's not always right, but it is just so much easier than going through blog posts and stuff. And I know Google now also, they come up with their AI answer at the very top, which is great, but their whole business is on its head with Google ad revenue, I think. But it's interesting, you go all the way up here, and Tesla, I didn't realize how high Tesla's PE ratio is. It is absolutely insane. And actually, if we take a look at Tesla, and let's look at just move this over. Let's zoom out on this chart. I don't know what the PE ratio was when it was back up here at almost $500. It's only at 320 now. So I can see why some people want to take a short position and say it's all hype and it's overvalued and everybody's moved in. Tesla has definitely a huge tribe that loves their stock, loves everything about them, and that's why it has such a high value. But you definitely don't want to put bets on just because the PE ratio is high. And NVIDIA is high as well, not nearly the same. Actually, I thought NVIDIA would be close to Tesla or actually higher than Tesla just because they're the biggest company and it's been kind of the talk for a long time. But anyway, still really high. But I just found it really interesting to those two where they are, just because I don't ever really look at PE ratios. They really mean nothing when it comes to trading, as we've learned. Fundamentals don't really matter. We just need to know when the trend is going up or down. If we take a look at the rest of the market, we've got bonds trading slightly higher this morning. They have been beaten up a little bit. Actually, bonds have a little bit of a cycle high here, telling us the market might run into a little bit of headwind. It is in a short-term downtrend and a long-term downtrend as well. It's kind of channeling to the downside. We've been talking about how bonds could come back down to these lows, which for TLT is very similar, right back down to these lows over here. It has definitely some big selling going on. This could easily flush back down and sell off. I'm not a huge fan of bonds. Short-term, long-term trends are both down. If we take a look over at the dollar, we do have the dollar down 0.5% this morning, so it's obviously running into its head into resistance. We talked about this yesterday, how it's popped right up into the 50-day moving average. We've seen this happen a few other times. We go back here and it gets rejected. So this big question is it going to find some type of bottom in reverse direction? If we take a look over at gold, so we've got dollar down. We have gold and silver up this morning. Only up a little bit in the grand scheme of things. Gold's been trading sideways. There's not a whole lot going on. And if we take a look at silver's has already had that pop and breakout, and now it's consolidating with lots of volatility, which is what silver does. It is volatile, but it's trading sideways here in that next move, getting ready to run up to that next upside target, which let's just grab a level here real quick. I know some of you wanted a level there. We didn't touch on gold or silver yesterday, I don't think. Anyway, it's got potential to about 40.80 as the next upside move. So it's come to the 618. We got the hiccup and the pause here, the pullback. So the next run, I think, is going to go to 40.80. And that'll be a fairly significant level. After we hit that level, it could do something similar to these. We're talking a month-long pause and pullback. So don't expect, the markets just keep blasting and going higher. Obviously, that's always an option, but that's the reality of it. It makes these strong moves, and then it goes dormant for a while. Let's take a look over at miners real quick. So let's take a look at GDXJ. They're actually underperforming. They've been trading sideways and don't have the longer term. They're in an uptrend. Trading sideways. They haven't broken out. They're kind of following more like gold. Gold is just sideways, trying to find some traction. And I've talked about how I'm not a big fan of the miners. I still prefer, if you were to trade something, it'd be physical gold or silver. I say physical, I mean GLD or SLV or any other ETF that holds gold or silver, because they're disconnected from the stock market. And I think they could do give you more upside potential, maybe without the volatility and a stock being stuck in the stock market. If the stock market does roll over, these are probably going to get hit, or they'll be muted. They just won't extend like the physical metals can because they're outside the stock market. Let's take a quick look at two last things. Overall, this is the IYR, the real estate REIT ETF. Overall, it is moving to the downside. It has this launch pad. It has this potential kind of rising channel or rising kind of flag. Overall, the pattern is down. This I do think the market does like to have these kind of upward running corrections. We had one kind of over here as well, where it kind of just chops and grinds its way higher. And then you end up with a little hook. People pop in. It has a big swing to the upside. And then it snaps down and has a huge reset. That's what this could do. I think we could see one final little squeeze up, get people sucked in. I've talked about a running correction to the upside, how dangerous these are. They can usually have a big fake out to the upside and then have a huge crack in correction. I think the real estate space could go and do something similar to that. Very little upside, tons of downside going forward. If we take a look at the dividend space, SPYD, which are the S&P 500 high dividend stocks, kind of a similar chart pattern. Lots of volatility. One day the stock market was up, the dividend stocks were down the most. It was definitely some interesting money flows going on here. Pretty clear. We do have a series of lower highs, and we have a series of lower lows, and more or less price kind of, breaks down, moves up into resistance, and then slowly reverses trend and eventually falls off a cliff. It breaks down to a new level, kind of through here, and it comes up, it's kissing goodbye, and eventually this could easily move down and then head lower. This whole pattern here, this breakdown, and it finds a top and eventually starts to lose its trend and its momentum, is actually kind of similar, well, is exactly what we're looking for in the XLE trade, where we have seen price break down, it works itself up into resistance, and then eventually it has kind of a breakdown and it forms a bearish pattern. And then if the stock market does roll over, we could have a discretionary trade to trade an inverse ETF in the energy space for a fairly significant move, which will probably be fairly violent in a good way. If you are short or betting on falling prices, we want a violent move, something like this. Something like this. That's your dream move if you play an inverse ETF. It means you get into the trade and like every day or in a short period of time, that ETF skyrockets in value. And that's how the market works. It takes a staircase up and the elevator straight down. Trading a bear market and trading falling pricing requires very different timing, very different mindset, and the trades are short-lived. You have to be aggressive in locking in gains. It's not about trying to catch the entire move. It's trying to catch some of it safely in the safest way possible and still benefiting from it. And that is the trick. It is easy to hurt yourself betting on a falling market, especially if you're in an uptrend, which we are right now. And I know many of you keep putting on and averaging into some inverse ETFs. I keep getting emails from you guys doing that. Just be careful. This market, just because we're bearish thinking doesn't mean the market is going to go down, and we don't want to fight the tape. Anyway, that's it for now. We'll talk to you soon. Bye-bye.